Today we will come to Chapter 2. In this chapter, we will learn about the concept of what is time value of money, how cash flows are classified, what factors affect the time value of money, and finally we will do some exercises to calculate the present value and future value of cash flows. In Session 1, we will clarify the basic issues of the time value of money. First, let's start with a classic question. If you had the chance to receive 1 billion, would you rather receive the money now or in 5 years? Obviously, most people want to receive money as soon as possible, because everyone understands that receiving money early will bring higher benefits. First, we will be able to earn profits from investing the money received. Even simply depositing money in a bank savings account will bring us a certain amount of interest. However, if you do not intend to invest, receiving money early will still bring higher benefits because of the depreciation of money caused by inflation. For example, 10 years ago, you could buy a house in the suburbs with 1 billion VND, but that is now impossible. The price of houses in the suburbs is now 3 to 4 billion VND. This is a typical example of the time value of money. The time value of money is a powerful and useful tool for financial decisions in valuation of securities and other assets, and in the analysis of investment projects. In Chapter 6, we will discuss in more detail the role of the time value of money in the analysis of investment projects in the company. The way in which managers will evaluate investment projects is based on the time value of money. Now let's move on to the classification of cash flows. First of all, we clarify the definition of cash flow. What is cash flow? Cash flow is a collection of cash amounts over a certain period of time. So, what is a single payment? A single payment is an income or expense that occurs at a specific point in time. The amount can be positive or negative, depending on whether it is income or expense. Here is an illustration of a cash flow with time points and corresponding cash amounts. This is how you will draw cash flows in the exercises that we will do in the future. In fact, there are many ways to classify cash flows. We often hear about cash flows out and cash flows in, negative cash flows, positive cash flows. However, for the convenience of calculating the value of cash flows, we will classify them according to the characteristics and time of appearance of the amounts of money in that cash flow. Accordingly, cash flows are divided into two main types, which are annuity and uneven cash flows. In annuity, it is divided into three small types: ordinary annuity, annuity due, and perpetuity. Now, what is the definition of annuity? Annuity PMT is a series of equal payments at fixed intervals for a specified number of periods. If the payment occurs at the end of each period, the annuity is an ordinary or deferred annuity. If the payment occurs at the beginning of each period, the annuity is annuity due. Here is an example to illustrate ordinary annuity and annuity due. As you can see from the slide, the basic difference between them is the timing of the payments. So, what about perpetuity? A perpetuity is simply an annuity with an extended life. Here we have a question. Does perpetuity exist in reality? In theory, people often use a stock with a promise to pay dividends regularly and forever to illustrate perpetuity. But the impossibility in this example is that no business exists forever to guarantee continuous dividend payments for its stock. This is the reason why perpetuity cannot exist in reality, at least for now. Maybe in the future, perpetuity can appear in some form, but that is a matter of the future. For now, the answer to this question is no. The last type of cash flow is uneven cash flow. That are all cash flows that are not annuity. It means that you just need to determine that a cash flow is not an annuity, then it is uneven cash flow. No need to think much about it. This is an example of uneven cash flow, and it is clear that it is not an annuity. Okay, we finish here. See you in next lessons.